Hello, folks. I'm Rodney Hathaway, Chief Investment Officer here at Waukesha State Bank Wealth Management, and welcome to our September edition of Market Chats. America and the world economy has gone through multiple growth and recessionary cycles over the past 50 plus years. The U.S. has experienced roughly 7 recessions going back to when I was born in the late 60s. Now, I'm not an economist, and we don't have an economist on staff here at the bank, but we often get asked by clients what our view is on the economy. As such, it is important for our investment team to track and analyze data that may impact the stock and bond markets and future values of the assets that are held in our client accounts. Knowing that the capital markets and economy will go through these cycles of expansion and contraction, we would like to share some insights on how investors can confidently navigate these cycles. While it's difficult to accurately predict the timing of market cycles, we can look at historical trends to make strategic decisions on how to invest for the future. One trend that we have observed is the general slowing of growth in the U.S. economy over the past couple of decades. This chart shows the annual growth of the U.S. economy on a rolling 10-year average going back to the 1950s. We created this chart using a 10-year rolling average to help smooth out the volatility year to year and to better illustrate the long-term trend. As you can see, during most of the 60s, 70s, 80s, and 90s, the band of economic growth in America ranged between 3% and 3.5% per year. However, beginning in the 2000s, growth slowed materially to around the 2% level. This slowdown in economic activity occurred during a period of tremendous technology advancement with the internet, high-speed mobile connectivity, and more recently, the advent of artificial intelligence. This begs the question, at a time when society is supposedly getting more productive with the help of technology, why was the economic growth slowing? The main culprit, we believe, is the continued expansion of government spending, which most taxpayers would agree has been out of control. With the passage of the big, beautiful bill earlier this summer, is there an argument to be made that government spending can be reined in? Can the tax cuts reverse the downward trend in economic growth that began 25 years ago? We know that the Tax Cuts and Jobs Act that was passed in 2017 during the first Trump administration coincided with an acceleration in GDP growth. More recently, economic growth for the first half of 2025 was 1.4%, but the Atlanta Fed now predicts 3% growth for the third quarter. The market is anticipating growth to accelerate as seen with the Dow Jones Industrial Average and the Russell 2000 Small Cap Index, both outperforming the S&P 500 in the month of August. We believe this recent market action is a harbinger of potentially higher growth in the back half of this year. For client accounts, we made a higher allocation to small cap stocks, in particular at the end of 2024 based on this analysis. So while our economy continues to be in growth mode, there is some growing debate on whether we may slip into a recession next year. Again, it's very difficult to predict timing of these cycles, but what we can do is help position client accounts to perform reasonably well in both an expansion cycle as well as a recession. Please reach out to any one of our advisors if you'd like to discuss this topic in more detail. And again, as always, thank you for tuning in this month, and we look forward to future chats with you.